The game of speculation is not, as the public imagines, a game of simple chance or of arcane secrets. It is the most fascinating and intellectually demanding game in the world. It is a business of calculated probabilities, a science of reading the future not through a crystal ball, but through the cold, hard, and impersonal facts of the ticker tape. Its mastery requires not a gift of birth, but a long and often painful education. This is a chronicle of such an education. It is the story of a speculator's mind, the journey of a man who, from his earliest days as a boy chalking quotes in a bucket shop, sought to understand the fundamental laws that govern the movement of prices. It is a story of immense fortunes won and lost, but more importantly, of the timeless lessons paid for with every single dollar. The speculator's great challenge is not the market itself, for the market is honest. It is the challenge of conquering the two great enemies that reside within every man, hope and fear. He must also conquer a third, even more treacherous foe, the greed that is born of success and the despair that is born of failure. The game is not in mastering the board, but in mastering oneself. This entire philosophy, this unvarnished account of a life spent in the great game, was documented with profound clarity by the journalist Edwin Lefèvre. His work stands as the single most important text ever written on the mind of a professional speculator. A link to his essential book, Reminiscences of a Stock Operator, can be found in the description below this video, for its lessons are the foundation of all serious market study. To understand the method, one must begin where the education began, in the bucket shops of New England at the turn of the century. These were not legitimate brokerage houses, but simple gambling establishments that took bets on the fluctuations of stock prices without ever actually buying or selling a share. It was here that a young boy, barely a teenager, learned his first and most important lesson. He was a quote board boy, and his job was to chalk up the numbers as they came over the wire. He began to see that the prices were not moving at random. They moved in patterns. History, he noticed, was constantly repeating itself. He began to keep a notebook, recording the movements of the most active stocks. He was not interested in the companies, in their earnings, or in their fundamentals. He was interested only in the numbers, in the behavior of the prices themselves. He was learning to read the language of the tape. He discovered that he could predict the short-term movements with a startling degree of accuracy. He would see a stock behave in a certain way, a pattern he had seen before, and he would know that it was a signal of an imminent advance or decline. He was developing an intuitive feel for the path of least resistance. With his small savings, he began to place his first bets in the bucket shops. His method was so successful, his reading of the tape so uncannily accurate, that he was soon winning more money than he was making as a quote boy. He became known as the boy Plunger. His success, however, brought a new kind of problem. The bucket shops were not in the business of losing money. They were in the business of taking the public's money. A man who consistently won was not a customer. He was a menace to their business model. One by one, the shops refused his trade or forced him to trade on prohibitive margins. He had, in effect, broken their bank. This forced him to a new and grander arena, New York. He arrived on Wall Street with a considerable stake, confident that his proven ability to read the tape would bring him even greater success on the legitimate New York Stock Exchange. It was here that he received his first devastating lesson in the difference between theory and practice. He soon discovered that the game on a real exchange was vastly different from the game in a bucket shop. In the bucket shop, a transaction was instantaneous. One could bet on a price and be in or out in a single moment. On the exchange, there was a delay. The ticker was often behind the real market on the floor, and the execution of an order was not guaranteed at a specific price. This small difference in conditions was enough to completely invalidate his old method. He was still reading the tape with the same skill, but the game was now being played in a different dimension. He was making the speculator's cardinal error. He was not adapting to the new conditions. He lost his entire stake. This first great failure was a crucial part of his education. It taught him that no method, no matter how successful in the past, is infallible. A speculator must be a student of conditions. He must understand the specific rules and the unique character of the game he is playing at any given moment. He began the slow process of learning the new game. He learned that on a real exchange it was not enough to be right on the short-term wiggles. The game was bigger. One had to be right on the great primary swings of the market. He had to learn to think in terms of weeks and months, not minutes and hours. The first great demonstration of this new, broader approach came in the spring of 1906. He had observed the market advance for a long time. The general conditions were prosperous, but he felt with a deep and growing conviction that the market was not acting right. It was a bull market, but it was not a healthy bull market. He noticed that despite the constant stream of good news, stocks would not advance. Money was becoming tight. He saw the signs of a market that had reached its peak and was struggling under the weight of its own success. He felt with all his speculative instinct that the line of least resistance was about to shift from upward to downward. He decided to go short. He began to sell the market, a profoundly unpopular and lonely position to take in a time of widespread optimism. He did not have a specific piece of news to justify his position. He had only his reading of the tape and his understanding of the underlying conditions. Then the unexpected happened. A great earthquake devastated the city of San Francisco. The market, which had been struggling, now had a definitive reason to break, and it plunged. His short positions yielded him a fortune of $250,000. The lesson was profound. The earthquake was the catalyst, the random event that the public blamed for the crash. But Livermore knew that the market had been poised for a collapse long before the earthquake occurred. He had been right not because he had predicted the news, but because he had correctly read the market's own internal weakness. The tape had told him the story long before the headlines did. This cemented his belief that a speculator must be a student of fundamental conditions. He must form his conclusions based on the evidence of the market itself, not on the hope of a lucky break or the fear of an unexpected event. His greatest triumph, the moment he was crowned the Great Bear of Wall Street, came during the panic of 1907. Applying the same principles, he saw a market that was dangerously overextended, a financial system built on a foundation of shaky credit. He knew a great and violent readjustment was coming. He began to sell the market short in massive quantities. His positions grew larger and larger as the market began to crumble, just as he had foreseen. He was not guessing. He was acting on his definite conviction, born of his dispassionate study of the tape. As the panic reached its crescendo, with banks failing and the entire financial system on the brink of collapse, he was a lone figure, a great bear, profiting from the widespread ruin. His fortune grew to over $1 million, a staggering sum at the time. At the very peak of the crisis, he was summoned by the great J.P. Morgan himself, who, through an intermediary, pleaded with him to stop his short selling, to become a buyer, and to help support the market. Livermore, recognizing his patriotic duty, agreed. He began to buy, and his buying helped to spark the rally that ended the panic. This experience taught him the true scale of the game. He had learned to think not just in terms of individual stocks, but in terms of the entire market. He had learned the power of sitting tight with a correct position, of having the courage of his convictions and riding a great move to its logical conclusion. He was no longer the boy Plunger. He was a master of the game. And yet the market has a way of humbling even its greatest masters. His next great lesson, the one that would cost him his entire fortune and cast him into the wilderness for years, came not from a misreading of the tape, but from a violation of his own most sacred rules. It came from the world of cotton. He had formed the opinion that cotton was destined for a great advance. His study of the conditions was sound, but he made a fatal error. He allowed another man, a brilliant and charismatic cotton magnate named Percy Thomas, to influence his judgment. Thomas was an expert, and Livermore made the mistake of valuing the expert's opinion over his own reading of the tape. He accumulated a massive long line of cotton. When the market began to turn against him, the tape was clearly telling him to sell, to take his small loss and get out. But Thomas, his new mentor, insisted that it was a temporary reaction, that he must hold on. Livermore, against his every instinct, listened. He held his position and even added to it, violating his cardinal rule of never averaging a loss. His desire to please his new friend was at war with his own cold, speculative judgment. The result was a catastrophe. The cotton market collapsed and he was wiped out completely. He lost his entire fortune and was plunged into $1 million of debt. He had committed the speculator's unpardonable sin. He had allowed another man's opinion, another man's hope, to overrule the clear, cold verdict of the ticker tape. This failure was the most profound and painful education of his life. It cast him into the speculative wilderness for years. He was forced to trade on small, borrowed stakes, slowly and painstakingly working his way back. It was during this period of exile and reflection that his philosophy was forged into its final, unbreakable form. He codified his rules, the laws that he now knew he must follow with the devotion of a zealot. Never argue with the tape, never take a tip, never average a loss, cut losses quickly, let winners run. And above all, a man must be true to his own judgment, a judgment based only on the action of the market itself. His triumphant return to the great game came during the roaring bull market of the First World War. This was the moment when all his hard-won lessons were put into practice. The market was a raging torrent, and he now had the skill and the character to navigate it. He applied his principle of trading the leaders. He saw that the war was creating a new set of dominant industrial groups, the steels, the shippings, the motors. He focused his attention only on the strongest stocks in these strongest groups. He famously traded Bethlehem Steel, the great leader of the war market. He bought it at its pivotal point and began to pyramid his position as it advanced. He was not afraid of its high price. He was attracted to its demonstrated strength. He had learned the art of the big swing. He stayed with his positions for months, riding the great wave of the bull market, ignoring the minor reactions. He was sitting tight, practicing the most difficult and most profitable art in speculation. His fortune was not just restored. It grew to a size that dwarfed his previous successes. In the book, the narrator, standing in for Livermore, provides a detailed masterclass on the art of stock market manipulation as practiced by the great pool operators of the day. This was not a confession of his own methods, but an explanation of the forces a speculator must understand. He explained that the manipulation of a stock is a scientific campaign, divided into 3 distinct phases. The first phase is accumulation. The insider or pool operator must acquire a large line of his chosen stock without causing the price to advance significantly. This is done with great patience and cunning. The operator buys the stock on moments of weakness, during dips and reactions. He will even sell small amounts to depress the price and to frighten the public, allowing him to buy even more at a lower level. His goal is to absorb all the floating supply of the stock into his own strong hands. Once the accumulation is complete, the second phase begins, the markup. The operator must now create a market for his stock. He must attract the public's attention and induce them to begin buying. This is where the arts of publicity and propaganda are employed. Favorable news stories about the company will suddenly begin to appear. Rumors of a merger or a great new invention will be circulated. The stock will be tipped in brokerage houses. The operator will engage in a series of active trades, buying and selling, to make the stock look strong and active on the tape, attracting the attention of the tape readers. The public, their greed now awakened, begins to buy the stock. Their buying helps to push the price higher and higher. The markup phase is underway. The stock is now becoming popular, and the operator is carefully feeding its advance. The third and final phase is distribution. The operator, having marked up the price to his desired level, must now unload his massive line of stock onto the public he has so carefully cultivated. This is the most delicate part of the entire operation. He cannot simply dump his stock, for that would crash the price. He must feed it out, selling into the public's enthusiastic buying. He will often support the stock on dips, giving the public confidence, only to sell more on the subsequent rally. The volume of trading during this phase is often enormous, but the price makes little or no upward progress. This is the hallmark of distribution. Finally, when the last of his line has been sold, the operator withdraws his support. The stock, now in the hands of the weak and hopeful public, is left to its own devices, and it inevitably collapses, leaving a trail of destruction in its wake. This parable of the pool operator is a lesson in the importance of reading the tape. The amateur sees only the price movement. The professional sees the story behind the price movement. He learns to recognize the signs of accumulation and the signs of distribution. He learns to follow the smart money, not the foolish crowd. Livermore had a profound and cynical understanding of the psychology of the market crowd. He knew that the public is driven not by reason, but by the elemental emotions of greed, fear, and hope. And for this reason, the public is almost always wrong. The public is greedy. They rush to buy stocks at the very top of a great bull market when the news is best and the prices are highest. They are not buying on a reasoned analysis, but on the emotional thrill of a get-rich-quick fantasy. The public is fearful. They are terrified by the first signs of a downturn. They sell their holdings at the bottom of a market panic, often at a catastrophic loss, just at the moment when the wise speculator is beginning to accumulate. And the public is hopeful. They will hold on to a losing stock for months, even years, their position nurtured by the foolish hope that it will come back to what they paid for it. They are not speculators. They are involuntary investors. The professional speculator, therefore, must learn to think and act in a way that is diametrically opposed to the instincts of the crowd. He must buy when the crowd is fearful, sell when the crowd is greedy, and never ever allow the emotion of hope to influence his judgment. The science of timing, of knowing when to enter and when to exit, was codified by Livermore in his theory of pivotal points. A pivotal point is a moment in a stock's price progression that signals a change in its trend, a shift in the line of least resistance. To buy a stock at the precise moment it crosses a pivotal point is to enter a trade with the lowest possible risk and the highest probability of success. It is the moment when the market itself has confirmed the speculator's judgment. This requires the speculator to identify the correct pivotal point, to wait patiently for the stock to reach it, and then to act decisively, without hesitation, when the moment arrives. It is a method that replaces guesswork with a clear, evidence-based signal from the tape itself. This entire edifice of technical skill is built upon a foundation of sound capital management. Livermore's rules were simple and absolute. A speculator must always limit his risk, cutting his losses quickly and without argument. He must never average down a losing position. He must let his winning trades run, never cutting a profit short out of fear. And he must build up his position through pyramiding, adding to a trade only after it has already shown him a profit. These rules are the speculator's insurance policy against his own human weakness. In the final analysis, the great lesson of Reminiscences of a Stock Operator is that the game of speculation is a battle waged not against the market, but against the limitations of one's own mind. The market is not a benevolent friend, nor is it a malicious enemy. It is an impersonal force, and it rewards discipline and punishes ego. The successful speculator is the man who has, through a long and difficult process of self-education, achieved a state of profound emotional control. He has learned to think with the cool detachment of a scientist, to act with the decisiveness of a general, and to endure with the patience of a saint. He understands that the ticker tape tells a story, and that his job is simply to learn its language and to have the courage to believe what it says. He is a servant of the facts, not a master of his own opinions. This is the great timeless wisdom of the book. The path to mastery is an inward journey. It is the forging of a new character, a new mind, one that is fit to engage with the greatest and most challenging game in the world. It is the education of a stock operator,